Let's do another why is your pension being destroyed by your wealth manager and fund managers. It's not strictly a portfolio review. It's a little bit broader than that. Here's a bunch of funds. Let's see some of the stinkers over the last 6 months. Remember last year, and I'm doing this in January 2024, last year the NASDAQ was up 55% and the S&P 500 was up 25%. It doesn't mean they're tracking this, I'm just saying, because what you've got is environmental absolute return thematic equity. So why do these funds exist? That was down 26% in just 6 months. Of course, it won't be the only thing in your pension. You might be really unlucky and have, I don't know, an Aberdeen China Next Generation. That'll knock you down another 23%. Or maybe a JP Morgan China fund as well shoved in there. So let's have a deeper dive into what's causing some of these losses. Obviously, anything with China stank. The problem with thematic ones is this. They're very eye-catching, environmental. Fund managers get paid as a percentage of assets under management. So they want to get as many assets under management as possible because they get paid a percentage of that. So they divide things by geography, style, like growth, or theme, like environmental. That means they're ever narrowing down the gene pool from stocks they can buy. When they merge those, for instance, say, I don't know, China environmental opportunities, there's probably about 5 bloody companies they can pick from. So the statistical probability of them actually finding a good company out of a pool of 5, when there's about 10,000 that can go into my SIP or ISA, are pretty bloody limited. And there's proof. But guess what? It's brilliant marketing to be able to say environmental, because you've read about it. The BBC talks about it. So you go out and buy some. And you see your pension pretty much destroyed. Now, you might say, well, you shouldn't measure it over 6 months. You should measure it for 5 years. That's what they'd like you to do, because they know statistically the chances of losing money over a 5-year period are very small. But chance of losing money over 5 years in a bank account are also very small. In fact, they're zero. So it's not the chance of losing money because you could have a bank account. It's what about how much you've missed out on making? Hence why I started out with the NASDAQ or the S&P 500 as an example at the start. So that's what you're left with. You've got energy evolution. Share opportunities, again, mentioned China. Emerging markets, that was down 20%, a fifth of your pension destroyed in that one. Now, you might say, well, of course, you wouldn't just buy one. You would have bought a basket of them. Yes, I hope you would have bought all of these and lost only maybe 22%, not 25%. Congratulations. Well done. So what is the broader point I'm making rather than just complaining from the cheap seats and the sidelines? Well, what I see in my industry is too much of this nonsense going on time and time again. And what I suggest people should be looking at instead is high Sortino funds. In other words, ones which have a high average return compared to low downside volatility or risk. Sadly, fund managers will never tell you their Sortino. Now you know why. Like and follow for more. I'll try and continue educating you, informing you, and show you some better funds in future videos.